Working. It's a great pleasure to be here and be giving you this talk this evening. Sort of a once-a-year event when I come to give a talk. I try to vary the topic, and this time I've decided to talk about risk management in Islamic finance, exploring different aspects of risk management. I was prompted to do this particular talk partly because the Islamic Financial Services Board, which basically is Kuala Lumpur, which is the body which is responsible for advising regulators about how to regulate the Islamic finance industry, produced in December 2005, and it was developed further last year, some guiding principles of risk management for institutions offering Islamic financial services. And quite a lot of the issues which are raised and covered in that document, we'll be basically addressing tonight or this evening. Just to sort of stress that there is obviously considerable interest in this topic in the Islamic finance industry, naturally enough. Risk management is, of course, very much at the core of banking business. It's very much what all banks do, and Islamic banks are no exception. They have to manage risk in the same way. So that's what we're going to basically focus on. Moving on from the cover content slide, so looking at the actual contents, and to indicate what we're actually going to cover. First, I'm going to talk about credit risk. We'll have quite a lot to say about that, and how credit risk can be managed. And of course, the crucial issue is what's different in terms of managing credit risk if you're an Islamic financial institution as opposed to a conventional financial institution. Or indeed, if you're a conventional financial institution, which is providing Sharia-compliant financing facilities, what's different about that part of your activity as opposed to the conventional part of the activity within the bank? So we'll have a look at some of the issues involved in managing credit risk. Talk about basically the late settlement of obligations due to genuine financial difficulties. Inevitably, there are late settlement difficulties quite often. So we'll talk about what can be done in terms of Islamic financial institutions, given basically Sharia principles and teaching on the subject. We'll also talk about repayment risks and unscrupulous defaulters, because obviously there's an issue with Islamic finance that potentially Islamic banks and Islamic financial institutions themselves can be exploited by the unscrupulous because of basically the principles under which they're operating. So how do you avoid that? So again, we'll have a look at that. So we look at the different dimensions of credit risk and how Islamic banks go about tackling that. Both in principle, and I won't be going into the actual experience of particular institutions during the course of the lecture, but we are happy to address these sorts of issues and questions and answers afterwards. Other dimensions of risk which one has to look at are liquidity risk. Clearly, all financial institutions potentially face liquidity risk. In the case of banks, including Islamic banks, it's quite normal to have a mismatch between assets and liabilities in terms of maturity. In particular, banks and Islamic financial institutions typically take in money short-term and are basically advancing doing the financing for longer periods. So if we look at the trends in terms of the changing composition of Sharia-compliant assets of Islamic financial institutions, in some ways the liquidity risks are increasing. So we will say a little bit about what can be done perhaps to mitigate some of those risks on basically the liability side. And we'll highlight basically some of the ways that can be done. Foreign exchange risk, we're considering under liquidity risk, but obviously it's somewhat different. It arises where you've got basically, again, a mismatch between basically liabilities and obligations in particular currencies. This is an issue, I think, a much underrated issue in Islamic finance, given the main centres of activity, which are, of course, here in London, but also, more importantly, in the Gulf, and of course, in Southeast Asia and Malaysia. And of course, many of these currencies are pegged to the dollar, though there have been some shifts, for example, in the case of Kuwait, in the case of Malaysia. But nevertheless, foreign exchange risks are very real. So one of the issues is what can you do in the field of Islamic finance to basically cover yourself from foreign exchange risk. What's legitimate, what's not legitimate, because there are some things that aren't legitimate in terms of covering these risks. We'll talk about operational risk, which again is this kind of risk which arises within a financial institution. Basically, in a sense, it encompasses different aspects. One is the adequacy of the reporting systems themselves. That can be the reporting system to outside stakeholders, including the depositors of the institution, and of course the shareholders of the institution. But also, it can be the management reporting systems internally, so that they keep track of what basically everyone is doing. And there are certain issues with regard to operational risks that are particular to Islamic banks and Islamic finance institutions that we talk about. We'll also talk a lot about, a bit about reputational risk and transparency, and what can be done with regard to that. Obviously, different institutions and different jurisdictions have different levels of transparency, and that applies to Islamic banking as conventional banking. And again, we'll say a little bit about all of that. Operational risk is about, to some extent, also handling people internally and making sure that everyone is under control, if you like. Basically, that is an important aspect of any banking operation. But again, there are particular things in Islamic banking which are significant. Finally, but in some ways most importantly, we'll have a look at basically legal risk and regulatory risk, and indeed Sharia risk, which is of course something unique to Islamic banking. And you will see in due course what we mean when we talk about Sharia risk. I mean, obviously there are different rulings by different Sharia committees of different Islamic financial institutions. One writer even talks about Sharia arbitrage, which is a very controversial notion. We'll say a little bit about that. I don't actually believe in that myself, but clearly it is potentially something that could be there. So we will talk about that. And in particular, this comes down to the issue of consistency in Sharia governance. Given the way this governance is managed, I think this raises all sorts of issues. I mean, I'm doing some work for the Islamic Financial Services Board myself on the issues of Sharia governance. They wanted to kind of outside to it rather than Sharia scholars or Sharia scholars. So there are quite a lot of issues, I think, which arise in respect to that. Okay, so that's where we're going, basically, over the next half hour, I guess. And then we'll take questions and answers. Okay, we start with basically the issue about, as far as credit risk is concerned, we start with late payments obligations. Late settlement of obligations is a genuine financial difficulties because clearly, quite often people take out commitments. This could be through Sharia compliant financing. It could be, for example, a JARA, which is kind of unique operational leasing, and then they find that they're not able to make the lease payments. For whatever reason, the rental payments in the lease. It could be a Marabba transaction, in which case maybe they're not paying the markup and they do not pay the principal. So quite often these things do arise. How do we actually treat this? Given the teaching in the Quran on basically on the issue of debt. And the kind of teaching is set out in Surah 2, 280.